In personal finance, investing secures long-term prosperity. Mutual funds offer growth and stability. As we approach 2025, opportunities abound. Choosing the right mutual fund requires knowledge and prudence. It's about building a solid foundation for lasting financial well-being. Avoid quick returns, focus on long-term goals. This guide helps you navigate mutual fund selection in 2025. Understand different mutual fund categories and risk-return language. Align your investment strategy with financial goals. Make informed decisions for a secure financial future. Successful investing starts with clear financial goals. Categorize goals into short-term, medium-term, and long-term. Assign monetary values and time frames to each goal. Prioritize goals to focus on critical objectives first. Use financial calculators to estimate required investments. This clarity helps craft an effective investment strategy. Prioritizing ensures critical objectives are met. Streamline focus and resources for impactful milestones. Tailor investments to meet specific financial goals. Long-term goals can take on more risk for higher returns. Medium-term goals need a balanced approach. Hybrid funds offer growth and stability. Short-term goals require conservative strategies. Debt or liquid funds ensure capital preservation. Balance risk and time horizon for financial goals. Longer time horizons allow for higher risk. Shorter time horizons need conservative approaches. Long-term goals benefit from equity mutual funds. Medium-term goals need a balance of growth and safety. Short-term goals focus on capital preservation. Understand the relationship between risk and time. Make informed decisions to optimize your portfolio. Mutual funds diversify your portfolio. Managed by professionals, they pool money from investors. Categories include equity, debt, and hybrid funds. Equity funds offer higher returns but higher risk. Debt funds provide steady returns with lower risk. Hybrid funds balance growth and stability. Choose funds based on goals, risk tolerance, and timeline. Diversify your portfolio for long-term success. Equity funds generate substantial long-term returns. They invest in the stock market, participating in economic growth. Large-cap funds offer stability with moderate growth. Mid-cap funds balance growth and stability. Small-cap funds have high growth potential, but higher risk. Long-term investors benefit from market cycles. Stay invested to mitigate volatility and benefit from compounding. Equity funds cater to varying risk appetites and goals. Large cap funds invest in well-established companies. Mid-cap funds target companies with growth potential. Small cap funds focus on high-growth, high-risk companies. Growth funds seek high-growth companies. Value funds find undervalued companies with strong fundamentals. Blend funds combine growth and value investing. Understand fund categories to navigate the investment landscape. Hybrid funds balance growth and stability. They invest in both equity and debt instruments. Aggressive hybrid funds aim for higher returns with more risk. Conservative hybrid funds prioritize capital preservation. Balanced hybrid funds mix equity and debt equally. Hybrid funds simplify diversification within a single fund. They provide growth and income for varied investor needs. Past performance isn't always indicative of future success. Evaluate mutual funds over various timeframes. Compare performance to benchmarks and peers. Consistent outperformance indicates a robust strategy. Consider fund manager expertise and expense ratios. Assess risk-adjusted returns for a comprehensive view. Combine performance analysis with other factors. Make well-informed investment decisions. Assessing fund manager prowess. Behind every successful mutual fund stands a skilled fund manager, the maestro orchestrating the investment strategy. Think of the fund manager as the captain steering the ship, making crucial decisions that impact your financial goals. Evaluating the fund manager's experience, investment philosophy, and track record is paramount. Start by examining the fund manager's tenure with the fund. A longer tenure suggests stability and familiarity with the fund's philosophy. Frequent manager changes can disrupt the fund's strategy. Research the fund manager's experience, educational background, and notable achievements. Delve into the fund manager's investment philosophy. Some managers favor a growth-oriented strategy, while others adopt a value-oriented approach. Align the fund manager's philosophy with your own investment goals. A mismatch in investment styles can lead to frustration. Scrutinize the fund manager's track record. Have they consistently outperformed their benchmarks and peers? Do they have a disciplined investment process? A strong track record instills confidence in the fund manager's abilities. Section 3. The price of success. Decoding expense ratios and their impact. Investing in mutual funds comes at a cost, and understanding these expenses is crucial to ensure your returns aren't eroded by high fees. The expense ratio, expressed as a percentage, represents the annual cost of managing the fund, deducted from the fund's assets. These expenses cover various operational costs, including fund management fees, administrative expenses, and marketing costs. A lower expense ratio means more of your money is working towards achieving your investment goals. For instance, if a fund has an expense ratio of 1%, it means that for every $1,000 invested, $10 will be deducted annually to cover expenses. Over time, even seemingly small differences in expense ratios can significantly impact your returns, especially for long-term investments. Compare expense ratios across different funds within the same category. Actively managed funds, where the fund manager actively buys and sells securities to outperform the market, typically have higher expense ratios than passively managed funds, such as index funds, which aim to replicate the performance of a particular index. While a lower expense ratio is generally desirable, it shouldn't be the sole factor influencing your decision. Consider the fund's performance, fund manager expertise, and other relevant factors in conjunction with the expense ratio. Sometimes a slightly higher expense ratio might be justified if the fund consistently delivers superior returns, justifying the additional cost. Section 4. Navigating risk and reward, understanding risk-adjusted returns. In the realm of investing, risk and reward are intertwined. Higher potential returns often come with higher risk, while lower risk investments generally offer more modest returns. Risk-adjusted returns help investors evaluate how much risk a fund takes to generate its returns, providing a more nuanced view of performance beyond absolute returns. One commonly used measure of risk-adjusted return is the Sharpe ratio, which calculates the excess return generated by a fund for each unit of risk taken. A higher Sharpe ratio indicates better risk-adjusted performance, suggesting the fund manager has effectively balanced risk and reward. Another useful metric is the alpha, which measures a fund's performance relative to its benchmark, taking into account its beta, a measure of the fund's volatility compared to the market. A positive alpha indicates the fund manager has generated returns beyond what would be expected based on the fund's risk profile. Understanding risk-adjusted returns helps investors identify funds that consistently deliver strong performance while effectively managing risk. It enables investors to make more informed decisions, aligning their investment choices with their risk tolerance and financial goals. Remember, investing always involves some level of risk. Risk-adjusted returns provide a valuable framework for assessing and comparing different investment options, allowing investors to choose funds that align with their individual risk appetites and return expectations. Exploring niche opportunities, sectoral and thematic funds. Sectoral and thematic funds cater to specific investment themes or sectors, providing targeted exposure to industries poised for potential growth. These funds concentrate their holdings within a particular industry or trend, offering a focused approach to capitalize on specific market opportunities. However, they come with higher volatility and potential losses if their chosen sector or theme underperforms. Thorough research and a long-term investment horizon are paramount when considering sectoral or thematic funds. Riding the wave of innovation technology and sectoral funds in 2025. As we stand on the cusp of 2025, the global economy is undergoing a profound transformation, driven by rapid technological advancements. Technology stands poised for remarkable growth, presenting compelling opportunities for discerning investors. Technology has become an integral part of our lives, permeating every aspect of modern society. From artificial intelligence and cloud computing to e-commerce and digital payments, technology is reshaping industries. Sectoral funds focusing on technology offer investors a front-row seat to this transformative journey. By investing in a diversified basket of leading technology companies, investors can gain exposure to the growth drivers of this dynamic sector. Weighing the risks and rewards. A prudent approach to sectoral and thematic funds. Sectoral and thematic funds offer enticing opportunities but come with risks that investors should carefully consider. These funds expose investors to greater volatility and potential losses if their chosen sector underperforms. Sector-specific risks include regulatory changes, technological disruptions, or shifts in consumer preferences. Concentration risk is another factor, as performance relies on a few key companies. Be wary of thematic funds based on short-lived trends or fads. Approach these funds with caution and thorough research. Diversification is crucial, and these funds should be part of a well-diversified portfolio. A long-term investment horizon is essential to ride out market cycles. The power of consistency introducing systematic investment plans, or SIPs. SIPs embody the principle of consistency, key to long-term success. Invest a fixed amount regularly, typically monthly. Navigate market fluctuations and enhance returns over time. SIPs break down your investment into manageable installments. No need to time the market perfectly. Build your portfolio gradually with a steady approach. This approach offers several advantages. Automate investments. Prioritize saving before spending. SIPs offer a psychological advantage, especially for novices. Spread your investment over time. Become comfortable with market fluctuations. Mastering market volatility, rupee cost averaging, and the benefits of SIPs. SIPs mitigate market volatility through rupee cost averaging. You're buying units at different prices, averaging your cost. When prices are low, you acquire more units. This can reduce your overall cost per unit, enhancing returns. SIPs take the emotion out of investing, fostering long-term growth. Congratulations! You've embarked on your investment journey, carefully selected mutual funds that align with your financial goals, and even embraced the power of SIPs. But your work isn't done yet. Investing is not a set-it-and-forget-it endeavor. It requires ongoing attention and periodic adjustments to ensure your portfolio remains on track to meet your evolving needs and aspirations. Think of your investment portfolio as a garden. You've carefully planted the seeds, chosen the right fertilizers, and ensured adequate sunlight. However, even with the most meticulous planning, regular maintenance is essential for a thriving garden. Similarly, monitoring your mutual fund portfolio allows you to identify any weeds that might be hindering growth, adjust your watering schedule, investment strategy as needed, and ensure your portfolio remains aligned with your financial goals. Regular monitoring doesn't mean obsessively checking your portfolio every day. In fact, frequent trading based on short-term market fluctuations can be detrimental to your long-term returns. Instead, aim for a balanced approach. Reviewing your portfolio every quarter or semi-annually allows you to track performance trends, identify any red flags, and make informed decisions without succumbing to market noise. During these reviews, pay attention to key metrics such as fund performance, expense ratios, portfolio holdings, and fund manager changes. Compare your fund's performance to its benchmark and peers, ensuring it remains competitive within its category. If a fund consistently underperforms or deviates significantly from its stated investment objective, it might be time to reconsider your investment thesis. As you monitor your mutual fund portfolio, you might notice that the original asset allocation has drifted from its intended target. This drift can occur due to varying performance among different asset classes. Rebalancing involves realigning your portfolio to its target asset allocation. This might involve selling a portion of your holdings in the outperforming asset class and reinvesting the proceeds in the underperforming asset. Rebalancing helps maintain your desired risk level and ensures that your portfolio remains aligned with your long-term financial goals. As we conclude this exploration of mutual fund selection for long-term investing in 2025 and beyond, remember this: the most successful investors are those who approach the market with a long-term perspective, a disciplined mindset, and an unwavering commitment to their financial goals. The journey might be filled with twists, turns, and occasional bumps along the way, but staying the course, making informed decisions, and adapting to changing circumstances are the hallmarks of a seasoned investor. Choosing the best mutual fund is not about chasing the latest hot stock tip or succumbing to the allure of quick riches. It's about aligning your investments with your life goals, whether it's securing a comfortable retirement, funding your child's education, or achieving any other long-term aspiration that brings you financial security and peace of mind. Remember the key takeaways from our journey. Begin by defining your financial goals with clarity and precision. Assess your risk tolerance honestly, understanding that higher potential returns often come hand in hand with greater volatility. Explore the diverse landscape of mutual funds, understanding the risk-return characteristics of different categories, from equity funds to debt funds to hybrid funds. Don't let the abundance of information overwhelm you. Empower yourself with knowledge, seek guidance from qualified financial advisors if needed, and remember that the best time to start investing was yesterday. The next best time is today. Every step you take towards securing your financial future is a step in the right direction. Embrace the power of consistency through systematic investment plans, SIPs, gradually building your investment portfolio over time and benefiting from the magic of compounding. Monitor your investments regularly, not with anxiety, but with a discerning eye, making adjustments as needed to ensure your portfolio remains aligned with your evolving financial goals and risk tolerance. Investing is a journey, not a destination. It's about making conscious choices today to reap the rewards tomorrow. So embrace the long view, stay informed, remain disciplined, and watch your financial well-being flourish as you navigate the exciting world of mutual fund investing in 2025 and beyond.